Hello and welcome to the 26th lecture of the course Forex in 3 steps. This lecture we will talk about divergence in classical analysis. In the previous lectures we have learned how to draw a trend line and how to identify support and resistance areas and how to read price movements through candlestick patterns and how to read price movements through chart patterns. Now we will learn about divergence, which is something that can add so much detail to your trading and help you identify real and good setups. So what is divergence? Divergence, it is the discrepancy in the movement of a currency pair between the chart and the indicator. Divergence is considered one of the most important tools used to identify trend reversal signals. So, which technical indicators do traders use when looking for divergence? There are 4 main ones. The first one is the RSI, the second one is the MACD, third stochastics, and fourth the volume, the normal volume indicator. So what does that mean? What is divergence? Divergence is basically just as you can see here, we have the price doing something and the indicator doing another thing. So they're both moving opposite directions. This means that there is a divergence, and this means that there may be a reversal incoming to the financial market you are analyzing. As soon as you see this pattern, when the price is doing something and the indicator is doing the opposite, it's falling, and as the price is going up, this means there is a divergence. There are many types of divergences. The first type of divergence is the irregular divergence. This type gives a strong reversal signal and is divided in two: a regular bullish divergence and a regular bearish divergence. So basically, the regular divergence has a bullish case and a bearish case, just like anything, and the market can't go any other way than two ways: either bullishly and goes up, and bearishly and goes down. So the regular divergence indicates a strong reversal signal. And here's a little cheat sheet for you. You can see here a bearish indication of a regular divergence is when price is going up, but there is signs of exhaustion, which we can find out by looking on the indicators. Our indicators, when they are falling off while price is still making higher highs, this means that there is exhaustion in the market and the market may be reversing very soon. And on the other hand, the bullish case is when prices are still doing lower lows and lower highs and moving still in a downtrend, but the indicator is doing the opposite and it's actually accumulating and going up. This indicates that there may be a bullish reversal in price. The second type of divergence is a hidden divergence. This type gives a trend continuation signal and is divided into two: a hidden bullish divergence and hidden bearish divergence. So basically, again, a regular divergence means that there is a signal for a reversal, and a hidden divergence is a continuation signal. That is the only difference. And here's another cheat sheet for you. A hidden divergence is the exact opposite. When price is going lower and it's making lower, and the indicator is doing the opposite and it's going to the upside, then this means there is a hidden divergence, and it means that there will be likely a continuation of the current trend. And here for the bullish scenario, if prices are going upside to the upside and it is continuing to go to the upside, this means, and the indicator is doing the opposite, which means it's going to the downside, that means that there is a hidden divergence, bullish hidden divergence, and this means there will likely be a continuation of the current trend. Here is the full divergence cheat sheet for you. You can take a picture. So how do we trade divergences? For bullish regular divergences, it appears when the price forms lower lows and the indicator forms higher lows. The trader enters a buy position after confirming the reversal, such as a resistance breakout or a reversal candlestick. So basically, divergences, you cannot trade them alone. It is not recommended to trade them alone. It is best for you to trade them alongside other methods and other strategies. We learned and we will still learn more strategies, but again, just like the example here, it is best to trade it alongside support and resistance, alongside candlestick patterns and other chart patterns. And for a bearish regular divergence, it appears when the price forms higher highs and the indicator forms lower highs. The trader enters a sell position after confirming the reversal, such as breaking support or a bearish candlestick. So again, you need to use it as confluence to add more trust to your trades and make them better trades. Same thing goes for the hidden divergences. When you see a hidden divergence, you can start looking for chart patterns such as ascending or descending triangles to make sure that the divergence is telling us that there will be a continuation in trend, and the chart patterns or the candlestick patterns or support and resistance levels are also indicating that. So when both strategies and both indicators are saying the same thing, it is likely that the trade will work out and you will profit from the trade. Let's take a quick live example to see what divergence looks like in real life. This is the Bitcoin chart. I opened it on the 4-hour chart, and as you can see, price here formed a double top. As you can see from here, it formed a tap and another tap, and then price plummeted very to the downside very much, very aggressively as well. So how can I use the divergence to confirm my trade from here? You add the indicator we talked about. One of the indicators, you can use RSI, you can use the volume, you can use whatever you'd like. But in this example, I will use the volume indicator because I like it the most. So here, as you can see, when we were here at this top, we had this volume, this high volume. And when we came here, even though price made a higher high, as you can see, price on the volume indicator made a lower low. So what does this mean? This means that there is a opposite. As you can see from here, the indicator is saying something, right? The indicator is dropping while price is making a higher high. That means that there is exhaustion and there is signs of a bearish regular divergence, as you can see, and that means that you can here confirm a short trade by checking and seeing a divergence as well as a double top, and this is how you trade divergences. And if I go back in time again on Bitcoin, there was exactly a very similar type of trade that was very possible, where here, if you look at the indicator, the indicator was making higher highs while the price action was making lower lows, and this means that there is exhaustion in price. Price is going lower, but the indicator is going higher, which means there is a regular bullish divergence, and that is how we reversed from here by making this model, making 1, 2, and we had a 3 here, which is kind of a head and shoulders pattern, but it is a bit untidy, or you can call it a double tap as well, or a double bottom, as whatever you'd like, and then we reversed from here. So as you can see, I don't trade the indicator alone, I don't trade divergences alone. I use it with other chart patterns to succeed in my trading and take the best possible trades, which we call A+ setups. And that is it for this lecture. See you in the next one.